Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Monday, October 27th, 2025. It's 11:27 a.m. Eastern Time. So I'm starting the video, and here's what I'm going to do, and I'll try to keep it in this order in case you want to skip ahead on anything. We'll start out with the equity markets, as I often do. Really what I want to do is go over all the main asset classes. Those are stocks, bonds, commodities, and crypto. I kind of put in its own little asset class there. So we're going to go through and not do a deep dive in any one of them because it would take forever. So if I was going to do a video on just the stock market, I would cover numerous indexes. I would cover the top sectors of the S&P 500 at least, the top stocks that matter the most, the big Mag 8, whatever you want to call them. So we'll do a quick overview in QQQ. The only two that I have out as trade ideas right now are QQQ and IWM. Although, like I've said, SPY will probably keep up somewhat relatively well to whatever QQQ does, I think, because the financials are either going to make or break here soon. And if they do, they tend to drag the S&P 500 down if they go down. And if they don't, if everything's hunky-dory, they can help lift it. So just keep that in mind. If you prefer SPY over QQQ, they're probably going to move. QQQ will always move a little bit more, but SPY should keep up. Then I'm going to roll into just a quick update on commodities. It won't be all-inclusive. You know what? I'm going to add here DJP. I want to show you the commodity index. But I want to talk about the grains. They still have very constructive long-term charts and what's been keeping those down. I'll get to those in a second. We'll talk a little bit about what's going on with China and soybeans. And then gold, silver, GDX. Quick update there. I got some charts out to you today. There's a couple more I want to cover. And then Bitcoin. I mean, that sounds like a lot. It took me over a minute just to tell you what I'm going to cover. But here's it in a nutshell. This is QQQ. We're going to look at three time frames. This is the 60-minute chart. We're going to start out here with these purple levels. So over the last at least week or so, I started giving you three color-coded boxes. I'm sorry, they're all the same color. Three purple boxes. These were areas that I listed would be objective short entries. Number one would be any kickback to this level right here, but not above. I made very clear in all these videos that's the no-go zone. No shorting there, in my opinion. Not objective to short, add-on only on drops back down below this level, and then the recent lows right there from Friday when we put in those bearish and call things a couple weeks ago. And I gave you a third zone. I said, and the reason this was a no-go here is because my next objective short area would be a back test of the primary uptrend line. Again, this is this primary trend line. On the 60-minute chart, I just have it coming off the September lows, but it's the same trend line that comes off the very key pivot low, I should say, the pivot low of early April. And so those are in the levels, and we're back to this one now. So in other words, from 603, which is where that last purple zone was, it's about a 3.8 move. And we're very close enough right now to say it's subjective. But I'm going to add what I've continued to add. This week is the biggest week on steroids that we've had for many months, maybe a year or more in the markets. You have the all-important Fed meeting. We know what they're going to do, but it's more about what they're going to say. I'll comment on that in just a second. And then again, you can't overestimate or underestimate I should have said it right. You can't overestimate the importance of the market leading stocks, how many, and I already covered those last week. So look into it. There's a flurry of the majority of the Mag 8 stocks reporting this week. So that's going to probably be the most important thing in the market. All right, so this is it. It is an objective short. Now, whether you do that or not, I told you my trading plan, and what I highly suggest around this time is on index shorts, just about all positions, longs as well. I tend to suspend stops heading into this week. Again, it's usually you have that. We don't always have the Mag 8s always reporting 1 week like we do now, but when we do, and there's a Fed meeting, that's just double double juice right there for the markets. So I'm going to hold off, as I told you, through the end of the week, because the last of them are going to report Thursday afternoon. So we'll have the Fed out of the way, all those big earnings out of the way, and then we'll go from there. So that's it. It's objective. Now, what I always say, the problem with shorting a trend line, a back test of a trend line, or a potential problem, is you can continue to test. As you retest, you go higher and higher. There's one thing. And then sometimes there's no guarantee you can't punch through there. So it is objective. Let me just say that, hard stop. It is an objective short. I'm highlighting it now for a subjective short that I've highlighted since right here. The back test of these levels following the breakdown. Of course, we had one there. And that's it. However, if you want to wait to see a rejection, remember, anything you see between now and Friday, really, in my opinion, is going to be noise. Unless something big happens early on with the Fed or one of the early reports or a couple of them, and you happen to take out these lows. I'll stand by that. There's no way. Anything else in here is noise to me, right? Hopefully that makes sense. So that's still the big level, those Friday's lows, Friday from a couple weeks ago, and anything else is noise. And as I've made it very clear, I talked about the we're toggling over to a daily chart, and this is the daily, and then this is the weekly. So as covered in recent videos, because we have, and I bring this up, that we had that it's not unusual to see. And we saw it back here. You put a bearish engulfing candle. Again, I'll take them 10 times out of 10 times. I gave you initially, and you may stick by that, a stop just above the high of that candle. So you would have been taken out Friday. But in my experience, when the technicals are still very much the same, we had back here a divergent high. I've mentioned at the time, bearish engulfing candle. We went on to make a ever so slightly, almost about the same marginal, ever so slight higher high, and then put in another bearish engulfing. And that also followed the trend line break right there. So right now, we had two sell signals a few weeks ago. They happen to come together, the primary trend line break off the April lows and the bearish engulfing. They were completely unrelated to one another. One is candlestick charting, a whole different discipline, and then the other is just trend line support resistance. And so you had them both fire there. And so far, just like here, this time we went up and made the marginal new high a little sooner, but that's all that happened there. And then a bearish was put in. So that's what to watch for this week. If we get another bearish, just because the last few haven't worked, again, I shouldn't say that. This one didn't work. That one worked. Right, and that called that 26% drop right there, marked a significant top, and so that's that. So we'll see what happens there. You can also extend. This is a longer-term uptrend line right here off the 2023 lows. That was a very significant low right there in the markets, end of that last bear market. And so basically, we continue, as you can see here, to backtest that one from below as the divergences grow bigger and bigger there. All right, so that's it. No change in the technical posture other than on the daily time frame that bearish engulfing was taken out. And on both time frames, the daily and the weekly was taken out. However, we're still below the trend line. The only other index that I've been covering quite a bit lately is IWM. No change there. And again, according to my trading plan, it's what I modified last week. Stops are now on a weekly close above, so that'll count this week. So there's really no hold off. That's just, let's see what we get through this week. I'll decide what to do on my positioning then on the indexes. But a solid weekly close above that, would trigger a stop. It's not going to change the technical posture other than you have a new high. But you'll still have big divergences on IWM. When you look at it long term, remember, IWM is at the top of this massive multi-year trading range right here. And last time we got up there, here you can see there's a good example of stop pops. You almost have to expect them. I've said that many times. I've learned over the years, been trading for decades, and you can almost see where all the stops are going to be. And the powers that be, have the ability to do that. If you have enough money to move the market, to pop these stops, they see them up there. What they do is they pop it. They get, all the shorts start getting squeezed out. It sucks new longs in, and then they reverse it. They go short there, and then boom, the move comes. So you don't always get them. Sometimes you'll fail right at a high, but it's almost more than usual now. Same thing on the downside with little false breakdowns. You guys know that on a lot of the long trades we have. I'll look for those false breaks. To like UNG, for example, predicted they could take out the recent lows and probably reverse it and then go up from there. And that's what they did. So there it is. There's IWM. And again, most important to me right now, we'll go back to the daily chart, is this is the same key uptrend line off those very significant April lows right there. Breakdown back test, we're still comfortably below it. And that's it. And remember, at the end of the day, an index short is one position for most people. I don't know. Maybe there's somebody out there, some of you that only trade one thing, only trade gold, only trade the S&P 500, only trade that. As you know, I'm a big fan of diversifying in a trading account, just same with an investment account or a 401k. Don't put all your eggs in one basket. That means different sectors, a possible asset allocation, just things that have low correlation, or in some cases, inverse correlations if you want to hedge up, or depending on what you're looking at. So that's it. No change here in IWM. We already back tested and had that rejection. That's what I like to see off a trend line when you're back testing. We've had one rejection there, another rejection there, and it's been resilient, but we'll see. This week will make or break it. I have little doubt about that. It's either going to see these markets rip to new highs, well beyond this little marginal new high. This one's about equal on IWM, but I'm talking about QQQ. Or it'll be the start of the drop down to these targets, and then the longer term targets that I have on the other time frame, weekly time frame. Okay, so that's QQQ, IWM in a nutshell. I'll just do a quick update on TLT. Nothing big there. We still need to take out. We have some support right here we've been dancing on since the sell signal. We gapped down, broke down below the wedge. And this is still your first target, the uptrend line, and then second and third target. Again, treasuries seem like they're in somewhat of a holding pattern with the Fed on deck. We'll talk on that real quick. Now, let me hold that off for my coverage on gold and the U.S. dollar, and then I'll talk to you about the Fed. All right, so that's nothing else to say. This one's halfway down to the first target and looking good. Okay, let's move on to, let's do the grains first, then we'll do the metals and the dollar, and then Bitcoin. All right, so, okay, we're starting to get some movement in the grains. Those are wheat, corn, and soybean are your big three, and they tend to move together. This is a chart I've been highlighting for quite some time now. This is my primary uptrend line on wheat. These are wheat futures. This is the continuous contract, so they just splice them all together as they're rolling. And this is a extremely significant uptrend line. We bought this. We've been buying wheat off this uptrend line, as I have been now for about past year. And the uptrend line is certainly holding. What we need to do is start getting away from these recent lows. You have a series of lows here, you're kind of wedging down, and then the runs in wheat, once it inflects, and again, the technicals are there. I can't say the utmost degree of confidence. There's a lot going on right now with the trade wars, and that's in part held soybeans back a little, and then wheat and corn. A lot of, Ukraine's also the world's second largest or whatever producer wheat. So I don't know what's going on there, but they tend to move together, and that's because they are to a greater degree or another alternative food sources. I always say you can go into your favorite Mexican restaurant or the fajitas. They're going to ask you if you want the corn or the wheat tortillas with it, and so again, they tend to move together. And so the call is really on all three. And that's it. And so wheat will come down. And then when it goes, there are times where it can be a little erratic. but there's also times, just like natural gas, it can run, and it really wants to run, and that just has to do with imbalances. Um, Climate change. There's a lot involved. I'm not an expert in commodities, believe you me, but I do know that wheat and corn, for example, and even soybeans, they're grown in temperate climates, and they tend to have the same weather conditions, and again, they track together. So that's it. I just wanted to reiterate, we have, just like here, all these are my weekly chart. We're going back into the mid 90s, and you can see these runs. I've highlighted them many times before that come off these divergent lows. And so going forward, this one still looks constructive to me. Now let's drop down to the more shorter term time frame. We'll look at wheat. We'll go to a daily chart. You can see it here. Probably the best trend line I would give you, let me zoom, is this one needs to go. This one comes off. He went parabolic here. That was after the Russia-Ukraine invasion there, and the wheat prices going crazy because of, again, Ukraine. But this is it. So we continue to make, and again, you can see it on that more significant weekly chart I just went out to. We continue to diverge, and I always say divergence isn't a buy signal, but what is would be a pop with this level right here. And let me give you two. Let me borrow this trend line, or I'll add a new one here. Okay, right there. If you're using WEAT, which I know the majority do here, I'm always glad upon request. I like to trade wheat futures myself, and I'll be glad to give you a chart. So actually, I'm adding this now. Yeah, I can see here we had a nice trend line off that high, came in, captured all these reaction lows, and you can see we had a reaction low there. We had it was resistance right there for a while, and we also have quite a few reactions on this level. So this is a support zone that, if popped, will likely take us up to the trend line, and then you have the downtrend line, the 200-day moving averages, and then you can see some longer term targets. So again, wheat is a bottoming play, diversification. And we'll get to corn and soybeans now. Corn, like I've stated for a while, corn's been holding up, but in that divergent low, very constructive chart too, especially on the weekly chart long term. And corn needs to take out, you can see the downtrend line right there above. And it's still an extension of a long-term trade. We hit our first target. This is when I started highlighting them back here. Hit T1, we hit it again. Longer term, and I'm talking, for high double-digit gains, you're going to have to take out that T1 level. And again, it's a constructive chart. And once again, it's one of many trades if you decide to take it or just want some asset allocation. Somebody asked, where, if we do have a bear market coming up, it's going to be ugly, what are some of the places to make money? And I don't think there'll be a lot. I think treasuries could actually go down again like they did last bear market. But the grains look constructive, and that's it. So, and then soybeans. Now, the big thing in the headlines lately has been China refusing, in the trade wars, not wanting to buy U.S. soybeans. Trump's trying to get them to do that. Well, you just heard Besant come out yesterday, and the headlines were both China and the U.S. said, oh, yeah, talks are going well. Trump's going to meet next, I think it's on Thursday. And we'll see what happens again. The important thing is, that Trump wants China to start buying U.S. soybeans again. He doesn't want to have to bail out the farmers here. And so either way, with all that going on, soybeans have been holding up. And again, same story. We hit my first target there. We hit it again. We're at it right now as I'm doing the video. That's why I wanted to update them. 2273. I haven't touched that level or modified in a while. It's a key level. And so supposedly talks are going well. So if China resumes buying soybeans, then boom, you could see a nice run there. And I can all but guarantee if soybeans happens to run up here, you're going to see wheat and corn most likely follow suit. So there's your update on the grains. As far as commodities as a whole, and that whole farce, I'm not the only one. A lot of people critical on how the government reports inflation. I've told you you can, other than digging into the CPI and looking at each individual thing, and we know that the government imputed a lot of the data due to the government the shutdown. And however, they have to report the CEI due to Social Security. They have to give your Social Security increase once a year, and it's based off the CPI. The numbers to me, and there's always, of course, tremendous amount of money involved in this, pressure for the government to understate these. We had, just to kind of recap, I've always said the closest thing to a real-time inflation indicator is a broad-based commodity index. Even though it's not perfect, far from it. Housing is the largest component, but I do look, and you can look at Zillow, the Zillow National Home Price Index, get an idea where home prices are. Even then, I know that the CPI uses owner equivalent rent, but that's going to follow. If the primary residence, so home prices are going up or down, rent prices are going to go up and down with it, right? And for those of you who are not familiar, you can look it up when I'm talking about the owner's equivalent rent component of the CPI. But what we had here, that was that runaway inflation. And again, by just about all metrics, looking at long-term charts, we ended a bear market in commodities when COVID hit. It was a nice, clean, unmistakable downtrend. This, I maintain, was most likely the first leg up in a new bull market with a corrective wave. And we've started, in my opinion, the next wave up. So commodity prices, again, don't mesh with what the CPI is telling us, because you can see we peaked back, trough back here, troughed a few times. Really nice support right there, that 29, 27. This is what I've done this the past for you. I didn't feel like doing it this time. I didn't have a high degree of confidence because I think these numbers are being fudged right now or not being accurately represented. But where I've been able to look at this, these boxes just represent each month, calendar month. And you can see what commodities have done. Remember, the problem with this is these are raw commodities. So in the CPI, it's not a bushel of wheat, it's a loaf of bread. It's what you pay. So not the raw commodity, but the finished good. However, we all know that if wheat continues to rise and corn continues to rise, so will ultimately a loaf of bread. They're going to have to sooner or later pass that on to consumers. And you could see the downtrend where inflation abated. Remember, inflation is the rate of increase in prices. And then it's a clear uptrend. You do not have to be an expert market technician to see we're in an uptrend and have been. So there's inflation for you. And make no mistake about it, this will permeate its way into prices. And there is a clear and unmistakable uptrend. And in fact, if you look at it this way, I think I have it on another chart. Yeah, no, I don't. We had a little correction off that divergent eye. There is a divergent eye here, but in a bull market, I said last week, came up with a new saying, bull markets are paved, the road to a bull market top is paved with negative divergences. You're going to get them all along, and they'll play out for a little correction, and then you resume the uptrend until one of those divergences finally mark the high. Again, by my analysis, it'll be right or wrong, we're nowhere near an end to what by all metrics so far appears to be early stage bull market action in commodities. So I just wanted to point that out and talk about inflation pressures and all that, because the market really cheered the numbers, even though we're still over 33% above the Fed's inflation goal target of 2%. We're still running about 3%. So I'll get to the Fed here in 1 second. Why don't we start there? I'm going to do it backwards. We're going to finish up with gold, but I want to start the dollar first. Okay, because the dollar, as I've talked about and showed you, and you can pull your own charts. You'll go back decades, compare the U.S. dollar to gold, or if you want to do it an easier way, go to UDN, which inverts the dollar. That's the short dollar ETN, and overlay that, and you'll see, again, you're going to have to go back because there are periods of disconnect where there's overwhelming demand for or selling pressure on gold. And in those rare instances, the impact of a rising or falling dollar won't matter if it's overwhelming. But in a normal market, normal conditions, a rising dollar is bearish for gold, and a falling dollar is bullish for gold. Simply because that's how gold is priced. And so it takes more dollars when the dollar's dropping to buy 1 ounce, and that's going to make the price of gold go up, as it very much did throughout this drop here in the dollar. So back here, called for a bottom in the dollar based on this large multi-year trading range. We put in nice, strong positive divergence. We went up. We hit that first price target. We just hit it again. We're sitting there, and we need to break it. If we break it, a solid break above 28 should take us up to my next target. And this is where I figure what I call the POR, or point of recognition, where gold bugs will start to realize this isn't just, the dollar's been chopping around. It's been basing here. Now we could certainly go down and then ultimately break down the bottom base. So many are calling for. So many that I listen to that are calling for much, much higher numbers in gold and silver, are expecting this, and that factors into their outlook. And they may be right, and I'll tell you what, they're probably going to be right if that happens. However, if the opposite happens, that could be very powerful, and that usually is when in the markets, when everybody's expecting one thing and the opposite thing happens. That's usually you get a big move there. Either way, we're there. Like I like to say, resistance is resistance until unless taken out. But now let's talk about the Fed. Okay, so this is the CME Fed Watch tool, rate watch tool. So this is where you go. Futures traders tend to be your more sophisticated traders. How many of you trade this? What is it? ZQ, I think. The Fed Fund futures. I've traded them in the past. Most people don't even know what they are, but that's where the smartest of smart money tends to trade. And so they're usually right. Rarely are they wrong. So this is it. So looking at a 1/4 point cut, you can see the current target rate's 4 to 4.25%. So they're pricing in that after this week's meeting, we're going to have dropped a 1/4 point. That's right now about 97% chance, with almost a very little chance of no cuts. So there are 3 scenarios or possibilities, right, with the Fed this week. I'm talking them real quick. The Fed, in recent decades, the Fed just doesn't surprise. They haven't done a surprise cut since going back into the 90s, early 2000s. They telegraph everything, and they won't go against the market because they don't want to tick it off. At least that's been the case. So let me just say, this is the most likely scenario. Any betting person is going to bet on this, only you're not going to get paid for it right now because that's the norm. It's priced in, right? You could have betted on that earlier, months back, and maybe made some money. Now, there is a very, very small chance, but a chance that they don't cut rates because, again, inflation, as I just stated, is far from their target. The market, on the media, and the headlines are all in consensus. Everything I read, they've said that pretty much. Last week's CPI report locked it in. Well, and maybe so, probably so. But just by chance, if it doesn't, remember, that's not priced in right now. There is a possibility of a 50 basis point cut. I don't even see it here. It's not even, there's no odds for a 50 basis point cut price in the Fed Fund future. Now, 50 basis point cut would probably scare the market, so that wouldn't be a good thing. Let's just put it over here. The market would most likely freak out thinking the Fed sees something that the market doesn't, maybe a problem in the financial system, which I said maybe the next shoe to drop. So that's one scenario, probably bearish for the market in my opinion, even though the market would normally like a 50 basis point cut. No cut is very low odds, so the takeaway is, what would that do to the dollar? The dollar should explode if we have no cut, because remember, what the dollar only goes up and down. It doesn't trade in a vacuum. It only goes up and down based on the other currencies that it is benchmarked or trades against. That's the euro, number one by far, and then the yen a distant second. So just keep that in mind, guys. If you're trading dollar-sensitive assets, I'm spending a lot of time talking on this because most of you, I guarantee most of you don't trade Forex. Some do, I know that on the site. And you can trade as a pure play, absolutely. There's an ETF, or ETN, I should say more specifically. Or you can trade futures or Forex, however you want to trade it. All right, so, and again, the euro is by far the largest component of the dollar index, coming off a divergent high right here. Let's use this tool with nice support right here, really nice support. That was that previous high. We broke out, back tested, have one little whipsaw there, and we've been holding that level. So that would be a falling euro, means a rising dollar. That's bearish for gold. And if it goes the other way, then that should be, again, doesn't guarantee where gold's going to go. It's just a net headwind. If the euro goes up and the dollar falls, that should be a net tailwind, net bullish for gold. All right, so watch that and just realize, again, guys, if you're trading gold or any dollar sensitive assets, just know this week has the potential, just like with these earnings, to either make or break or determine the next big move in gold. It could come pretty sharp. All right, so there's that. And now let's get into the metals. So gold is clearly above the, we had the sell signal one right here. Broke the uptrend line, back tested, divergent high. We hit my first, second target bounce. We're coming up on T3, and that's my fifth and final target zone. Again, on the daily chart, it's a little clear. There's the primary uptrend line, breakdown. Last week, we broke down, we back tested, breakdown, back test, rejection. So that's where we're at right now. And then silver, is this the one I got out to you today? No, I didn't get out. So, but we're at support right now in silver. This is my 60-minute chart at SLV, and we are at support right now. So there's a case that they may step in and buy silver. It's been a drop since the highs already of about 15%. I gave you the futures chart this morning. Those levels aren't always going to align because you have different reaction points and the ETFs than you do in the futures, which of course are trading around the clock. And then there's GDX, as I said, it's going to follow gold and silver, and very simple. So we had a sell signal there. We hit my first target. We bounced, as is often the case. Reaction upon the initial tag, each of my targets. Reaction's likely. Then we hit T2 here. We dropped down. T3 was hit. We bounced last week. In fact, just like the silver chart I gave you an update on today, this one was, I'll shrink it down a little so it fits in the screen. Same date, October 21st, right there, down on the bottom left-hand corner. October 21st, we hit my third target where I favored a bounce back to T2. So this is how you can juice up the return on a swing trade, by gaming the levels that you're likely to get a reaction. And there's a lot that goes into that, but you want to look at all the metals. The more of the related components, the dollar, the euro, gold, silver, GDX, the more of those that are at support at the same time, the more likely you are to bounce off that level. Otherwise, if one of them hits a price target, but the rest have just broken down below theirs or haven't yet hit it, then you might not get that bounce at that point on that particular one. So I trade these collectively and gave you my thoughts. If I give you back arrows, that's where it's likely going to bounce to. And then you can get back in. So you can, this is 5+%, maybe even more than that. And you can just recycle in like that. And that was, again, the last update I gave you there. And this is what happened since then. We bounced off T3. We had a little brief shoot and reversal right back above it. Hit T2 to the button. So that was just a textbook perfect re-entry point. And then boom, down here you are, close enough to T4 that if that's your final target and you want to cover, you could cover there. I may add additional targets later, but that's pretty decent support. And if things go, depending on how things go after the Fed this week, this is a potential target down here. So I'm just going to write this down here. I'm going to add it so I know to revisit this next week or later this week. I will be out of the office Friday. I'm leaving town Thursday afternoon, and we'll be gone. Potential final target, we'll call it right now. Potential just means depends. I'll have to see how the charts develop going forward, how gold develops, how this Fed meeting goes. If so, that's going to be a drop of about 30, almost 31%. So far, we're down 20 so far to the lows from the highs. Okay, and then finally, Bitcoin. It's a risk-on market. The last update of Bitcoin, I told you we're at the uptrend line. where you can make a case to buy if you're bullish on Bitcoin. The fact that's all you could do at that point. I said there's only one move to make, and that is to go long. Or if you're bearish, you want to wait for a break of that level. That it's the primary uptrend line right there. Comes off this is the Bitcoin ETF IBIT. This is when they all started trading, but that's the same thing on. It's the same primary uptrend line on Bitcoin, I believe you have there. So that's it. So I have a price alert set, and it's also a really nice support shelf as well that comes in there. These previous all-time highs right there. Then we broke out right here. We back tested. So this is just a big support level. And again, right now it is a risk on market 100%. The meme stocks are running. The NASDAQ 100 is outperforming, and it's like a light switch. The stock market, when that switch gets flipped on, risk on assets go, and that switch can get flipped off on a dime, and that is most likely, if there's going to be a catalyst to flip that switch off, I can think of none other than this week with these earnings. And again, that can keep that switch on too. If the market likes what the big fangs are selling, if they say they're just going to keep pouring money into AI, if they hint that they're seeing a return on the investment, that would be net supportive for the stock market and probably Bitcoin as well. But when I look at the chart, this is just big divergence right there. And then I'll just wrap it up with this chart. This is BTC, the Bitcoin crypto. And there's your primary uptrend line. It's nice and clean. There's your divergence right there. Again, this chart, I used to have it marked up here. You had the same thing back here. You had a big divergent high. Every so often Bitcoin has these big corrections, and they usually end with same thing, divergent low. It's a big divergent low. You probably had a trend line there as well. I had this chart marked up in the past. Every now and then there's annotations will disappear. This isn't futures, but in the case of the futures, the charts roll and I have to replicate them, but there it is. So, and that's it. So the next setup, it's in an uptrend, just like the equity markets. And but the equity markets already broke their primary trend lines. So the equity markets are below those. Crypto is still holding above right now, and waiting for a sell signal, which my sole target at this point in time, I'll probably add some more, is down here. Now, it depends if and when the trend line breaks down. From where prices are now, that support or that target's about 37% below current levels, but no sell signal at this point in time. And if we get it, then you have the other Bitcoin crypto proxies I've given you, like MSTR, MicroStrategy, which has already broken its trend line, but it's not going to go anywhere without Bitcoin. So you can see it broke down, hit my S1, and looks to be maybe setting up for a back test, but it's only going to go so far. It's almost certainly or most likely not going to get down to these targets until and unless Bitcoin breaks down. And then if so, to give you an idea, my third and final target is going to be a 65% drop if hit. Just down to T2 is going to be a 40% drop. All right, I'm going to wrap it up here, get the video out to you guys. Again, my updates will be light this week because I'm not doing a whole lot. Not keen on taking new positions. I'll update existing trades. If something really stands out, I'll throw it out there as a trade idea. But just keep in mind that we're going to see some volatility this week, most likely, with all the big earnings and the Fed meeting. Alrighty, this has been Randy Finney with Right Side of the Chart. Have a great day.